Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter, see what people are talking about, share my financial opinion on Twitter, and work our way through a bunch of different commodity and financial information. If you guys need any help with anything, you can definitely check out finding-value.com, become a member there, or you can follow me on Twitter at finding_finance. So first, we've got someone sharing breaking. Democrat Congressman Bowman calls for an end to America's oil and gas industry. We need to stop drilling for fossil fuels completely. I don't know what the drive is behind this. Maybe they want to distance America away from fossil fuels because there's going to be a gigantic move to the upside in it coming in the future. I don't know the whole reasoning behind why they want to get away from it. I don't think the green movement is necessarily the real movement. I think they are subject to price inflation under oil, and they want to try to get away from that. But it says calls for an end for the Americans' oil and gas industry. We need to stop drilling for fossil fuels completely. I don't think the timing is going to do very well. I think we're going to get a big, large surge for a wave 3, no matter what. It doesn't mean that it's going to happen immediately. I do think that we could still have a little bit more downside before heading higher, and maybe a little bit more of a washout, so to speak. But I think that's what their motive is they want to get off of it because of inflationary pressures. This is Jesse. He says, oil positioning is back to early COVID levels. So this is oil positioning is back to early COVID levels. This is managed money, and this is West Texas Intermediate. So this is the price in the light blue line. The dark blue line is managed money and the positioning. You can see the positioning is very low at the bottom of 2020 low, which means not a lot of people are in this market in terms of oil positioning. And when I see this, it makes me think that, hey, you know what? Maybe we're getting close to a low here. Maybe we've got one last little washout move before we head on higher. Here's Logan. He says, we have had 0 to 3.5% down payment loans since 2008. The debt structures of the loans all changed after 2010. No credit cycle resemblance of the loans in scale today versus what we saw in 2000, 2008. Hence, why we never had a credit boom either. So this is the large boom that we've had coming all the way up here. We came all the way back down. We've had a nice little kind of first move higher here, and then it's kind of pulled on back. This is the MBA Purchase Applications Index. The purchase index is in the blue, and the red is the 4-week moving average. What he's saying is that we haven't gone to a level way up here that resembles the previous peak. And he does not think that we are in a bubble based off of looking at this credit and MBA purchase applications. Coming on down, we've got, remember the Fight Club rules. We never talk about Fight Club. We never ever talk about new home supply data and tie it into the existing home sales market because the velocity of active listings with new homes has always been small, even during the bubble crash years. So this is new houses for sale by stage of construction is completed, and we are at a very low level. You can see where the level was and where we gained a bunch of inventory back in 04, 05, 06, 07, and then the peak and collapse in 2008. I don't think we're at that type of level, that's for sure. We're not at that type of level, and we're still at a very low period. Maybe if you were to look back, we are measuring at the beginning of the bull market of the real estate market of last cycle. So we're really low in relationship to history for at least completed homes and inventory. Here is Soren. He says, could very well happen the final flush in uranium. It says, worst case scenario. I once traced the movement from 2017 all the way till 2020. He took that fractal and overlaid it over what we have today. Is there one last flush out of this system? And it doesn't mean that this flush out is going to be as large as the previous flush down. That flush down is going to be dependent on the market conditions at that time. This was the COVID crash that really exacerbated that move. And again, I don't know if this is necessarily going to be the exact movement that it's going to do. He's just throwing up a fractal and trying to compare it, just like all of us are trying to do. Nobody knows the future. Nobody knows exactly how this is going to necessarily play out. I am still incredibly bullish on uranium from a longer term perspective. In the short term, things are moving all around, guys. Could we get a little bit of a downdraft here? We definitely could. But that doesn't mean that the supply side problem has necessarily been fixed. The supply side problem exists in all these different commodities. So it says in just 3 decades, it is estimated that 1 in 4 European, North American, and Asian residents will be over 65 years of age. It says the world's population is aging. Global population share of children under age of 5 versus the global population of people over the age of 65. And you can see this large area under this curve here versus the percent of children under the age of 5. Big difference here. And in 2100, the number of people age 65 and above will be 5 times higher than the number of children under the age of 5. That's crazy. Here is JSG. It says, we're $8 from what I calculate to be fair value for West Texas Intermediate. With negative sentiment such as now, price deviations will occur. Let's see those draws continue and price will cooperate. And he's talking about inventory draws. But we're about, we're a little undervalued. That's where the blue block is. And we're a little bit under the red kind of, we'll call it fair value price. If we continue to have inventory draws, which brings us to the left-hand side, we just get undervalued, more undervalued. So right now we're $4 undervalued to current levels, with his calculation at least. FHFA home price index hits a new all-time high. Savage, man, purely savage. So this is U.S. house price index. You can see we pulled back a little bit. Now we're starting to go and move up, creating a new all-time high in the nominal index. We're not at a new all-time high from the real index, but we are in the nominal. So that is interesting to see. I thought this was a cool chart. I haven't really seen too many of these, but this is gold's symmetry is what he calls it. We've got kind of this downside pressure there. It kicked out here and then went all the way up. Downside pressure kicked out, went all the way up. Downside pressure, we're going to kick out, move all the way back up. I don't know. We'll see. But it looks like we're right on support, and we'll see if we can break to the upside here shortly. That was gold. Game of Trade says leading economic indicators are contracting at levels that have a 100% hit rate for recessions. So this is leading economic indicators point to recession. The Conference Board leading economic indicators 6-month changes right here, but we are coming back up. Looks like a month or so. Keep in mind, though, we are at a very low level. There's a couple of other areas below us in terms of history. Maybe we've got one last flush out, but I don't necessarily think that's the case. If we go back and look, this is a housing market crash. This is a housing market crash. This is a housing market crash. This one isn't, and this one is. So we've got basically all of them but one, and this shallower one here is the one that isn't a housing market crash. So I think we could maybe even start heading higher at some point here. We'll see. And it doesn't necessarily mean that we're going to get a big, huge crash recession from a housing market, at least. And that's what the majority of these are led by housing market crashes. It says, as of January 2023, 60% of U.S. adults are living paycheck to paycheck. Is that what you see? Are a majority of the people you know living paycheck to paycheck? Of the people that I know, I would say I don't know a single person living paycheck to paycheck where they don't have a good amount of savings. I know my parents are not, my brother's not, people at work are not, unless, I mean, I think there's some that are at work. I just don't know them that well. But there's a few that I'd say are probably pretty tight with their finances just because they don't make a ton of money. But most of the engineers, most of them, none of them really talk about living paycheck to paycheck. They all own homes. They all have fixed rate mortgages for the most part. Um, yeah, I don't see too many. 3% mortgages are assets people aren't willing to give up. Well, I mean, I think some of us knew that we could be coming into an inflationary period, and we locked in our low mortgage rates. So, yeah, I don't want to give it up. I don't think anyone I know who's got a sub 3% mortgage wants to give that up. And anyone who's paid off their house doesn't want a mortgage again. So, yeah, I would say that's pretty accurate. It says great data on why this is a supply constrained market. This is housing. We have more transactions if there were more homes available to transact. So if we look at this, he says, I always look forward to getting new data for this chart. Even at 7% rates, 78% of all real estate agents tell us buyers outnumber sellers in their markets. And this is the buyers outnumber the sellers, buyers roughly equal to sellers, and this is the sellers outnumber the buyers. So it's still a seller's market to this extent. And right now, this is not looking like crash territory. Crash territory is when when it's 78% sellers outnumbering the buyers, outnumbering the buyers. This would flip where it's all orange with very little yellow and very little green. Coming down, it says, regardless how you look at this, it's never a good thing for African players or investors. And what's happening is Namibia is considering taking stakes in mining and petroleum companies. And a lot of people view this as negative. I'm not exactly sure if they're going to put up money to get these stakes or if they're just going to be given these stakes. I'm not exactly sure the whole ramifications. I know some companies already have Namibian stakes in their companies. And I don't know if that means that nothing's going to happen to those companies. I don't know the whole details of it. And I don't know if this is necessarily written in stone. I think they just kind of came out with this and caught a lot of companies off guard. But I'm not doing anything with my shares. I think I've appropriately sized the majority of my shares for uranium in general and the companies in the uranium sector. I'm riding through it. That's my take on it. So I thought this was interesting. This is Charlie. He says price to earnings ratios. Guys, look at these price to earnings ratios. Amazon's at 292. Nvidia's at 215. Guys, that's bubble territory in my opinion, but Tesla's at 59, Netflix 42, Microsoft 36, Facebook 33, and so on. Price to sales ratios, Nvidia's at 40, Microsoft's at 12, Tesla's at 8, and so forth. That's very expensive, especially Nvidia. Price to earnings and the price to sales ratio, very expensive. Some people may argue that they're going to grow into that price to sales and price to earnings. I'm not of that believer. I think that this is going to get ugly at some point, and I think they will go back down. I think we are in a bubble. I think that technology is putting in a double top, perhaps sometime soon, which is the bull trap. And then I think commodities are going to put in a bear trap. And I don't think we're done with either one of these yet. Not yet. It will be, I don't know, a month or two or whatever it's going to take to get this behind us. Now, I wanted to go over this. This guy, Happy Hawaiian, he did this in 2022. My God, mortgage rates are at now 7%. Home prices nationally are flat to slightly positive over the last 12 months. 3, 2, 1. And then these are a lot of these guys, if you look at, and maybe this isn't the one I retweeted, all the housing crash people in 2021, 2022, still in 2023, They continue to call for a crash, a crash, a crash, a crash, a crash. I know that I'm similar to calling for higher movement in commodities, and that hasn't materialized here in the short term yet. I don't think, looking at the fundamental data, that we're going to get this big blowout crash that some of these guys are expecting, just because the inventory isn't there yet. So we're still probably a year or two away from that, if that were to occur, if the inventory really starts to come on. I don't see that inventory coming on yet. So we're going to have to wait and see. And maybe they're still a year or two too early. Mortgage rates are at 7%, and home prices are not crashing. The narrative that increasing interest rates crash home prices is wrong at this time. It hasn't impacted it to the extent that everyone has said that it was going to impact it. They think that increasing interest rates are going to crash the market because it is going to impact the affordability. My argument is, I don't think that we're going to see a crash. It's going to be more resilient than what most people think, because of the supply-demand imbalance, because of the deficits in homes, and because of the low inventory levels. It doesn't mean that we won't eventually get a crash at some point, which I do believe in. I just think that we are way too early to make that call at this time. Here's the crash bros. So it says, time to create more BS to feed your sheep followers and get paid creating doom porn. I suggest using Elon Musk tweet for new content this week. Home price declines may be over, S&P Case Shiller says. And again, I'm not in the crash bros camp. I'm in the camp that it's going to be resilient for a while. Maybe it even goes back up because of the imbalance between the supply and demand. Real estate prices are not driven by affordability. They are driven by supply and demand. Affordability has an impact and can determine short-term market movements and how everything kind of moves together. If you increase interest rates really fast, obviously the market's going to have to digest that for a little bit. But it moves off of supply and demand, not the affordability. And if affordability goes down, yes, it will slow it all down. I don't think it can stop it and reverse it. Because what happens is you're going to have a market that gets weak, interest rates pull on back, and that demand still is there. So the real estate market, it can fall a little bit, but it can't crash. It can't do like a 30, 40% decline, because if we see that type of weakness in the market, generally what happens is interest rates fall. And if interest rates fall, I think that the affordability will go back up and people will be buying homes again. So it creates a floor on price. And that floor will just continue to step up if more and more buyers keep piling in. And even if affordability is bad at a particular time, you still have all those buyers and they're still out there saving more money to buy a house. It's just part of the demographic coming into home buying years. So yeah, the home market is 6 or 7 million homes in a shortfall, and we've got that demographic that wants to come in and buy it. So it's a supply and demand feature there. Here's Tavi. He says the ratio of NASDAQ 100 to Russell 2000 is now retesting the peak of the tech bubble's levels. This situation, similar to today, where smaller companies perform poorly compared to large cap companies, was a critical precursor of the tech bust. An important reminder, it's not all about growth. It's about the price one pays for that expected improvement in fundamentals. Tech mega cap companies are currently trading at nearly 30 times their projected earnings for 2024. Regardless of what anyone may claim about the recent AI advancements, this is probably one of the most speculative markets in history. This could be that Batman double top where it comes back down. We won't know that until we look backwards and see it. But right now we're at very high levels, and this is the NASDAQ 100 versus the small caps. That ratio. We're at a very high level for this ratio compared to history. Looking pretty frothy there. Eric Nuttall says, I cannot recall the chasm between narrative and reality ever being wider than it is today. This is about, Chinese demand hits oil, oil demand hits record, hits another new high. He talks about, holiday air passenger travel going up, and some of the guys forecasting May 24th, U.S. airlines forecast record summer despite air traffic controller shortage. Travel boom helps European airlines defy economic gloom, et cetera, et cetera. India's petroleum use at record high for 2023 on surging fuel demand, and that is what's in the news. The price continues to fall. We are going to battle between the physical market and the paper market, and that's what's happening. Right now, the paper market is still winning. As we saw, further up there, the positioning in the oil markets is at one of the lowest levels right now. So a lot of people sold out. Could be recessionary fears. Could be, I don't know what the reasoning is. Could be anything of why they had sold. Here's another one. It says, buying precious metals is naturally a contrarian position, as they do well when the seeds of economic mismanagement begin to sprout. So we have a lot of contrarians in this space. I'd say it's currently contrarian to think home prices will continue to increase rather than crash. I completely agree with that. It's very contrarian to think that. And this is, I shared this last update. So I'll end it there. That's what we've got for today, guys, and what people are talking about in the markets. Give me a thumb up for the content. Subscribe to the channel if you'd like. Subscribe to the website or Twitter if you'd like. And we'll see what happens over these next few weeks, guys. I know there's still some selling pressure out there. Some people are getting sentiment's low. People are getting frustrated with the commodity trade. We may go down further. That's part of the game. I think that we are at some point going to be at the bottom of wave 2. And then when wave 3 comes, that's what we're all waiting for. So be patient, hold on there the best you can, and I'll see everybody who's a Platinum member Sunday at 5 p.m. Mountain Standard Time. See you then. You can ask me whatever questions, and we'll catch you next time. This is Finding Value.